Welcome to the REI Foundation Podcast, where we cover all the steps and strategies to make your real estate dreams a reality. Now your hosts, Jason and Peely.
So do you fix and flip houses or invest in real estate or just want to get started doing so? Well, Alpha Funding has you covered with fast, flexible, and reliable service and rates starting as low as 8.99%. Fast closings, no tax documentation or bank statements required, no prepayment penalties, seasoning, or minimum draw requirements. Alpha Funding, the softer side of hard money. To get yourself pre-approved today, go to alphafunding.com or call 732-657-2014. Have you super excited about today's show. We're really going to dive in, and I'm excited. We have Nikolai Ray on the show. How are you?
Hey, Jason. I'm doing very well. How are you?
I'm doing great. So we're excited to have Nikolai on the show. He is the CEO of MREX, Multifamily Real Estate Exchange. He is considered by many of his peers as one of North America's leading experts in apartment investing with over $1 billion in analysis, underwriting, and transaction. A pioneer in mid-cap multifamily financial engineering, he is often called upon as a teacher, advisor, and keynote speaker. Nikolai is also a real estate tech innovator through his current work on multifamily real estate, big data, artificial intelligence, and property tokenization using blockchain technology. Well, we got a lot to dive in here, don't we?
Man, that's a mouthful.
I was going to say, you got a lot going on. Tokenization is probably the first time I've ever said that. And I was thinking in my mind, is this a word I'm going to start hearing over and over? I'm going to start putting into my vocabulary, but I love it, man. So thanks for coming on. And you have so much you're hearing, but let's just talk. What got you started in the real estate space?
So what got me started was actually at a pretty young age. I grew up in I was born in Canada, in Quebec, in the French part of Canada, and moved to Los Angeles when I was just under a year old, and grew up in Los Angeles. Came back to Montreal after the big earthquake in '94 in Los Angeles, and at that point, my life was focused on becoming a hockey player. I wanted to play in the NHL. So
Awesome.
So I ended up making it pretty close. I played 4 years of junior hockey in Canada, and then played professionally and semi-professionally until the age of 22. And as I was playing hockey, I was at the age of 16, 17, and my origin story can go pretty far back. But ultimately, I was I've always been very, very good at math and very business oriented. Probably starting at the age of 4. So I was 16, 17, playing junior hockey. I had done high school. I was already doing college courses, thanks to distance, using technology and everything, and started kind of playing around with the stock market, playing around with Forex. One of my dad's good friends was actually a quant, so he built a whole bunch of crazy algorithms for Forex trading, and I started kind of just playing around with that, following him around. And made a bit of money thanks to what he was doing, not to what I was doing. So after a little while, he was like, Nick, you're gonna have to learn how to do this stuff your own, and you can't just ride my coattails for the rest of your life. So I was like, oh, that's fine. I got what I needed. So I actually took the money that I made doing that, and had saved up a bit of money too, playing hockey, and put that money into a couple of my buddies wanted to buy an apartment building. And they didn't have all of the down payment necessary, so I helped them out. And that's how I got into it. Is ultimately I was like, okay, well, I'll put some of my money into this, and but I want to see kind of what are your numbers? What are you doing? What's the risk I'm taking? So I taught myself how to underwrite my own money that I was putting in behind them. I guess I was 18 years old at that time. And for about 4 years did that. And then at 22, put my money back into entrepreneurship because I stopped playing hockey, retired, and decided to go into business for myself. So I reoriented my assets and my capital into business. But that's ultimately how I got started in real estate, like more as a passion, more as an amateur investor. And fast forward to the age of 27, my third business, I started an investment banking firm in multifamily real estate, and we scaled that within 3.5 years from zero to $100 million in recurring annual transactions, and ultimately ended up working on got my hands on about $1 billion worth of transactions, and actually underwrote and worked on maybe analyzing another $10 billion worth of transactions. So that's it in under a couple minutes.
Yeah, dude, it's awesome. And I'm just thinking here, so many people, they're scared to go big, but it sounded like your whole objective is always to go bigger outside your comfort and then learn what you need to learn to get to that next step. And talk us through this here, because, even the first thing from an apartment building, you said, okay, I'm just going to teach myself underwriting. What is it in your core competency? What is it that allows you to take that big step, and where so many people say, well, maybe I'll start safe with a single family home or something and just kind of put my toe in the water?
Well, I mean, I think a lot of it amounts to probably upbringing and just activation of DNA. I don't want to take much credit for it, because ultimately I think, it comes from my parents. When I grew up, like when I was 4 years old, this is a story I like to talk about, is I was 4 years old in Los Angeles, and in the late 80s, LA was pretty rough. Like today, LA is awesome compared to what it was, right? So we were walking around downtown LA, which is now called LA Live. And at that point, all there were crackheads and homeless people, and, kind of mixed in with the crowd. And it was the streets were dirty. And at that age, I was already telling my parents, I said to them as we were walking to breakfast somewhere, I said, one day the towers that we see around here, well, I'm going to have a tower in each major city in the world, and they're going to belong to my company, and my company is going to clean the streets and feed the poor and give lodging to the homeless people, right? So that was at the age of 4. And my parents, instead of saying, well, that's ridiculous, or, maybe you should become a fireman or something, or they were like, well, hey, if that's what you want to do, then do it. You can do that. And that's kind of been, that was the guiding light of my upbringing. I grew up pretty poor. My parents were artists, bohemian musician, theater actresses, and so we didn't have much money. We grew up in very rough neighborhoods, pretty much the same, the ghetto or the outskirts of the ghetto. But I grew up with a lot of love and with the non-limiting beliefs of being able to do whatever it is you put your mind to it. And I'd say the second part of that is I've always had an enormous capacity for learning, and learning fast on my own. Like the easiest way to understand it is, if you remember the Matt Damon movie Good Will Hunting, I kind of have that same way of learning things. And I was 5 or 6 years old, and I was already doing math at a high school level, and I was already writing 200-word essays. So instead of being punished by not being able to watch TV, my dad would make me write a 200-word essay on why I acted the way I acted and what I can do in the future to not repeat that.
That's awesome.
That reaction. So that's ultimately where it comes from.
Yeah, it's so key though, your support group, right? And sometimes just a difference in people just deterring you, or just saying, okay, if you want to do it, how are you going to make it happen? Go make it happen. It's everything in life. So
exactly. And I mean, I think you have to constantly also train your mind and keep on pushing. And I mean, I'm discrediting myself right now and kind of saying that it would just kind of fall upon me as a child. But I mean, I have done a lot of work, and I continue to do a lot of work to keep on training my mind and trying to push everything that I do, that's the only way I feel like living. I don't think it's for everyone, but I think in life there are mostly two types of people who try and run away from anxiety, and people who try and run away from boredom. And, I spend my life running away from boredom. So
I love it. And with so much you've done, what does your business look like today? What are you actively working on right now?
So I sold my investment firm in 2016. And I sold that to start the company that I'm running right now called MREX, which is the multifamily real estate exchange. Ultimately, what we are is a tech startup in the multifamily space. So we're a fintech startup. And what we're focusing on is building technology and data, and especially actionable data, to help multifamily investors in the community just have access to kind of normal tools and stuff that stock market investors have access to right now, but that real estate investors don't have access to. So that's what we're focusing on building. We're focusing on building a standardized and unified marketplace for the multifamily property market space. And we're also putting the foundations to build a securities platform, which would ultimately become the NASDAQ of real estate, where you would be able to pretty much tokenize through blockchain technology a multifamily property, sell off shares, which are represented digitally as tokens, to smaller investors or more passive investors, and then they would be able to also retrade those shares, just like a stock market pretty much. So that's a longer tail project that we're working on. It's a 5 to 10 year project, and the short term project we're working on is pretty much creating an Expedia of multifamily, pretty much.
I love it. And so what's going to happen here in your opinion over the next, 10, 12 years ago, we don't even have the iPhone. And now here we are now just pushing so quick into the technology age with everything. How is that going to translate to multifamily? And where do you see people that are not engaging in some form of technology? Where are they going to be in 5, 10 years without using it?
Oh, they won't be in the market anymore. And I think ultimately people are, real estate is very archaic. I'd even call it Jurassic pretty much, because the stock market kind of became digitized in the 70s thanks to the NASDAQ, right? Real estate at the moment is not really digitized. I mean, I'm on a couple transactions right now just personally, and I submit an LOI through email. I get the LOI back. It's copy of documents. The broker sends me, the dates that I have to keep in mind, that I have to visit the property by say June 27th. I have to inspect the property, by 15 days later. I have to do this, and then I have to go and manually input those dates into my calendar. And it's like, this is such a messed up process. And then when I want to find data on comparable properties, when I want to find data on how the market's acting to actually help me price this asset and structure my capital stack, it's so time consuming. And I haven't even spoken about actually finding the property itself, which is quite a time consuming and energy inefficient activity in itself. So I think, technology has not even really touched real estate at the moment, especially not multifamily real estate, but it's coming. And ultimately, it's going to probably get rid of like a lot of brokers who don't bring any value to the space. It's going to get rid of a lot of unsophisticated investors also, because as we gain access to data, and especially alternative data, that means data with context, like not the stuff that you find on CoStar or these other websites, but actual business intelligence data that will help you make better decisions with regards to acquisitions, financing, how you invest CapEx into properties, and how you refinance out of all of that. Well, it'll make the market more efficient than what it is. And the more a market becomes efficient, well, the less you can just lean on relationships and insider knowledge, and the more you have to become a sophisticated investor and actually master a knowledge base that is much more, intensive, like understanding actual finance and economics and understanding how financial engineering can come into play into structuring capital stacks. And, you ultimately, it'll be the end of the landlord. Like, it'll be the end of just the apartment building owner. You'll have to be an actual investor.
I was just having this conversation with Chad Gallagher of Slate House. He's a property management company, and they're really pushing the tech too. And he was just talking that even the leasing process is almost going to push property management companies outside the door, because you no longer you have to say, okay, I'll meet you here. Can you meet Saturday at 12? No, I can't meet Saturday at 12. I can meet Saturday at 1. It will be like, oh, here's an automated process. You can see it visually on the phone. If you like, you can go there and just let yourself into the apartment. Just tour it around. If you like that from there, fill out an online application, go to that point, and almost just taking that step out. And what you're talking about is the opposite point. It's even just the acquiring or the disposition and acquisitions phase of multifamily properties is both going to happen in the same way, because right now it's like, oh, I get an insider tip that, Joanne's had this property, this building for 20 years. So maybe she wants to sell. And then I'm following your guidelines here. What from
and just to stop you there, what you just put your point on there with the management company, that's, I mean, the applications of the Internet of Things, IoT, mixed with artificial intelligence on that side of things is tremendous. And I mean, I'm at the forefront of all of this stuff. And on the acquisition side and the portfolio management side, we're talking about especially big data and artificial intelligence, which has not really found its way into real estate yet. Like, we're not even at the point where there's real big data in real estate at the moment. And big data is, probably like 10 years old. So, and then on the transaction side and the accessibility to the market, what blockchain technology will do is, I mean, it's going to be completely, in 10 to 25 years, it just will be mind-boggling how real estate's going to be done compared to today.
Now, I have to focus on the underwriting because you have so much experience in how much, just the volume of underwriting you've done over, $10 plus billion in transactions. How has your underwriting philosophy changed over the last 3-5 years, presently to today? What have been some key things that stand out to you?
It's funny because, some people are like, oh, you're the master underwriter or this and that. And, you must know everything. And, the fact of the matter is that there's so many great underwriters out there working for real estate investment trusts and private equity firms. I mean, there's so much talent. And the one thing about underwriting that you have to understand is you have to maintain a level of humility that that increases with your talent. So the more knowledge and talent and experience that you have, the more humility you need to be a good underwriter. Because, the way it changes, number one is underwriting has to deal with statistics, past, present, forecasting, has to deal with market cycles. There's so many moving parts. It's unbelievable. And, real estate is often oversimplified, because that's what sells courses and that's what sells seminars. But, it's such a complex asset class. There's so many moving parts. I mean, just when you're underwriting a property, in reality, what you have to actually underwrite is you have to underwrite the property market. You have to underwrite the space market, meaning, actual rents and tenants. And you also have to underwrite capital markets. And you kind of have to have a general knowledge of macroeconomics, which is kind of overshadowing all of that stuff. So it's very complex. And, most people only underwrite at the property level. And I'd say that's how I've became better over the last, technically I've been underwriting for probably, almost 2 decades now, pretty much. I'm 35. I've been underwriting since I was 18. But I've been professionally underwriting since the age of 27. So, just under a decade. And I'd say, going from what most underwriters do at the property level and then maybe integrating the space level, but then integrating capital markets into that and adding on to that the experience level and the humility that comes with that experience of having gone through different phases of a real estate cycle and going through actual different cycles and understanding that stuff, it just makes you a much more prudent and more precise underwriter. And I'd say that's the most important thing, because in underwriting, when you're underwriting a property and you're using DCF analysis, discounted cash flows, with like an Excel spreadsheet or a cruncher, the first thing people need to learn in underwriting is it's garbage in, garbage out. So if your inputs are garbage, your outputs are garbage, right? And underwriting, just like basic mistakes that people make, if you look at it, is the core inputs of underwriting a multifamily property are what's the exit cap rate, or what's the refinancing interest rate, what is the growth rate on rents, what's the inflation on expenses. Those are the key points, and they're very hard to predict and forecast, even more so if you don't have a background in statistics or if you're not a quant, right? And even if you are, the reality is, forecasting is a very imprecise and very unproven science, right? If we can even call it a science at all, right? Economics is it really a science? That's a big debate. So you have to find a way to understand that, number one, and have the humility to understand the limitations of your underwriting, and therefore strive to become a very precise underwriter. And how you become a precise underwriter is through constantly re-underwriting your underwriting. So, mistakes that I made when I was younger and that I think a lot of people make today is they'll underwrite ex ante. So they'll underwrite prior to acquisition and they'll just leave it at that, right? So let's say you're a syndicator, you do your underwriting, you do your offering through, say, a Reg D 506C, and you never really touch your underwriting again. no one is really continually underwriting. So what I do in my underwriting is I'll underwrite the acquisition, and then post acquisition, so ex post, I'll re-underwrite and concord my underwriting models every quarter pretty much, and adapt and continually readjust my forecasts and hypotheses to make sure that I'm being as precise as possible. And the way you become precise is obviously through knowledge, data, and experience, but also through continually readjusting. Because you don't have a magic ball where you just look into it and you're like, okay, this is what the future is going to provide with us. And the only truism in statistics and quant and economics is the closer you are in time period to your forecast, the better chances you have of being right? Forecasting the refinancing interest rate 3 months from now it's much more probable that you're going to be precise and right than forecasting the refinancing interest rate 5 years from now. I mean, that's just basic reality. So I'd say that's a major thing.
And for someone listening today that needs, just is corely focused on improving their underwriting skills, what are some of the lessons learned or things they really need to focus on today? Because you talked, on 3 different levels, we're talking the property market, the space market, the capital market, and most people are just analyzing on the property level. How should they be more fluent in the space for the market space and the capital space as well?
Well, they have to understand how those 3 kind of levers work together and affect one another, and can work autonomously but dependently. So it's a very philosophical way of underwriting, and you have to have that philosophy. I believe that strategies without philosophy are useless. So that's like, someone who says I'm a buy and hold investor. That doesn't mean anything. That means that's like saying a hockey player can only turn right, that he can't turn left, that he can't go forward, or he can't go backwards. That's one thing, right? Or that's like saying I'm a football coach and all I have as a strategy is a Hail Mary. And we just do Hail Marys every single play. And that's it. That doesn't make sense. So I think for people who are getting started in underwriting, before even understanding those 3 different levers of underwriting, I think the core thing is to understand, number 1, time value of money. It's a basic finance subject that so few investors understand. And putting time into understanding time value of money. I mean, we're not even at the point of understanding IRR and MPV and all that stuff. Just actually understanding conceptually and philosophically time value of money. Because once you have that understanding, then you can go on to the next level and start to understand the opportunities, but also the limitations of various underwriting tools like internal rate of return and net present value and opportunity cost and weighted average cost of capital, all things that you should be fluent in if you're underwriting a multifamily property. Because ultimately, when you're underwriting a multifamily property, you have to be able to price the asset properly. And the way that you price the asset properly is you're pricing future cash flows, right? Mm-hmm. And future cash flows are not only annual free cash flow, but it's also the principal part of your mortgage that's being paid down, and it's also the appreciation of your property and the appreciation of that market. So there's so many moving parts. The fact of the matter is that people think that they can learn how to underwrite in a weekend seminar or in a 20-hour course, when in reality, I mean, I teach underwriting and I've taught underwriting. We have an arm at MREX called the College and Research Institute of the MREX. We teach underwriting and financial engineering for multifamily investors. The fact of the matter is I have guys and gals that come through our programs that already have degrees in finance, and even 6 months in, they're not even at 10% of what underwriters at say my level, not to posture, but underwriters at my level are at, because it's such a complex field, but it's so valuable. If you're an investor or if you're a syndicator, you should be putting a lot of time in to learn everything that goes behind underwriting and then practicing and practicing and practicing and practicing.
So where are you focusing today with your underwriting skills? What metrics, what markets are really looking forward to you, looking at where you feel we are in this cycle?
Well, that's a really great question. I think, I think overall as the great Howard Marks would say, and I'll paraphrase him, we're in the late innings of the cycle. The only thing is, it's like a baseball game. We don't know if the game will finish in the ninth inning. We don't know how many innings there will be, and we certainly don't know how long each inning will be, right? So understanding that principle or that philosophy, I think ultimately it's a question of pricing assets properly and understanding the dangers and the opportunities of using leverage, using it wisely, and investing in markets where you have some safety. It comes back to before searching which markets you should invest in, you really need to look at what your own investor profile is, right? Because let's say if I have access to let's say if all of my down payments come from a couple ultra high net worth individuals that I get money from because I've built these joint venture partnerships with them, or I have these relationships with them, and they're only asking me for 5% return on investment because they're ultra high net worth individuals, but they want a 5% preferential that's practically guaranteed, even though you're not supposed to guarantee it.
Alpha Funding Solutions offers creative financing tailored to your individual needs. Whether you're fixing and flipping distressed properties or building ground-up construction, Alpha offers flexible financing to get the job done. With no minimum draw requirements, no prepay penalties, and no seasoning requirements, borrowers can create a construction loan that best suits their individual needs. Everything at Alpha is done in-house, from the sales force to underwriting, construction management, and draw payouts. The team at Alpha works as a unit to best serve their happy family of over 1,000 borrowers. Experience the Alpha difference today. Visit www.alphafunding.com or call 732-657-2014. Again, that's alphafunding.com, and the number is 732-657-2014. There's nothing to lose and everything to gain. Alpha Funding Solutions, the softer side of hard money.
My weighted average cost of capital is going to be very different than, say, yours if you have to, generate a 14% pref because you're a first-time syndicator, right? So that's the core thing, is understanding your own profile and the investor profile of yourself or your company or the investors behind you. That's the major thing. And then once you've done that, well, then obviously you're going to go and look at the different markets. I mean, if you have to generate a 14% return, you're going to be looking for high growth markets. Obviously, you're going to go for probably riskier markets because you're going to have to generate that growth, right? Or you're going to go for high growth neighborhoods or properties that are undervalued. And it's all a question of valuation. You're going to have to try to find properties where you're paying a certain price, but it's undervalued. And that's where I think a lot of people get it wrong, is they'll fall into the trap of saying, okay, let's look, and I'm trying to make this as understandable as possible because this is pretty high level stuff. But let's say you're looking at a property that's selling at $1 million. The cap rate on the property is 4.3%. But the cap rate in that market is 5%. So what people are going to generally make the mistake of doing is they're going to say, well, I'm not going to buy that property because the cap rate is lower than market cap rate, meaning the property is priced higher than what it should be priced at. And then they'll look for properties priced at, say, a 5.2, 5.3, 5.5. So let's say they buy a property at 5.5% cap rate. Now, the cap rate is the unlevered return of a property. If the property is at a 5.5% cap rate in a market that's a 5% cap rate, there might be a very good reason why it's trading at a 5.5. It's probably trading at 5.5 because it's in a bad neighborhood or it's a really badly run property. And the other thing is cap rates, you have to remember that the cap rate is a metric of a stabilized property. So if you're buying value add properties, you shouldn't be talking about the cap rate unless you're adjusting NOI based on the NOI that you'll get once it's stabilized, and adjusting sales price with the CapEx that you've invested into getting that new NOI, right?
I think that's one of the most important point, right? Because I think so many times people make the mistake of it's not stabilized, and they're looking at cap rate when the property's not stabilized, and that's where a lot of things go sideways.
Oh man, and they're missing out on deals because that 4.2% cap rate property, if you adjust the CapEx that you're putting into it, put that onto the price, and then look at your NOI in 8 months once it's stabilized, you might realize that your actual cap rate's 5.7%. But you passed on that deal because you don't understand cap rates, you don't understand NOI, you don't understand the levers you're playing with, and you don't understand statistics, right? Because the other thing is, if you're looking at the cap rate of a market, everyone makes a mistake of looking at an average or a mean cap rate or a median cap rate, which is a mistake because cap rate should be a range. You should be looking at what is the range of cap rates in the market I'm looking at. Now, if the range is between 4.7 and 5.8, well, you can understand that probably the 5.5 and higher cap rates are going to be in the C and D class neighborhoods, whereas the 4.8 is going to be probably a newer building in the better neighborhood, right? So those are all things that you have to kind of keep into mind. So, and to come back to your question, because that was a long-winded answer to not actually answer your question, is you got to look at demographics. You have to look at demographics of the markets that you're looking at. You got to look for growth. I did a webinar recently with Ryan Bourdon, who's the VP of a big real estate investment firm in the northeast of Florida in Jacksonville. And I'm also doing one with Gino Barbero, who is based out of Jacksonville, who invests in the southeast. And, we were talking about Jacksonville. It's a high growth market. Like Phoenix is a high growth market. So obviously, if you have to generate those values or returns, you want to go to high growth markets. And you also want to go to markets where you feel that even if the economy takes a dump, once we phase out of this cycle, well, you want to be in markets where demographically and economically they won't be affected too much despite the macroeconomic condition. Because even though we're in the late stages of the cycle nationally, you have to remember that multifamily is a local sport.
Yeah.
And you could be in a recession and still have multifamily markets that are actually not in a recession.
Yeah, that's well put, right? Because I was actually just talking about this. Not every city is just in the same cycle, and some cities maybe two years behind. And so where you're seeing here, if you're in Denver, well, that may be it's a whole different environment than I don't know, Toledo, Ohio.
Absolutely. You can be in Denver right now and be in oversupply and be kind of at the tip of the tip of the crevice, right? Tip of the mountain right there. Whereas you can be in Phoenix and you still have a lot of room for growth and expansion. So.
You're looking high growth markets, so you're doing a lot of webinars on Jacksonville. Is that a market that's really meeting the metric that you're going after in properties? And for you, we touched on cap rate, but properties, of course. Where is Nikolai Ray playing right now? What kind of properties are you looking for?
It depends on who I'm investing for or who I'm analyzing for. So if I'm doing it for my ultra high net worth individuals and private equity firms, I'm looking more for like the blue chip markets. Growth won't be as high, or it won't be as it won't be as high, but it'll be more stable, and it'll continue to grow even say in a bad macroeconomic condition. Whereas if I'm more in a wealth creation process, say as a younger investor or someone getting more started off or a syndicator, well then I'm going to go to more higher growth potential markets where there's a path of progress. So obviously Jacksonville, because we mentioned that. I think the whole kind of if you go diagonally from the northeast to the southwest of Florida, so from Jacksonville across to Orlando down to Tampa, that's a big path of progress, I believe. And I think Phoenix in Arizona is another one. There's some pretty cool places. Utah I love, like Salt Lake City and Provo. Very interesting markets. Even a place like Boise, Idaho is very, very interesting. So there are various markets. Obviously, there are places that I kind of shy away from, even with the ultra high nets. I'd say like the northeast of the U.S. is a bit more of a scarier market. The Rust Belt is. I see a lot of people going into the Rust Belt, going into Cleveland, going into those markets. You have to make sure that you know what you're doing. I see people buying properties at 8% cap rates, 9% cap rates in Cleveland because they say, well, I can't find anything. All the properties in Seattle are trading at 5 and 5.5% cap rates. Well, they're trading at 5.5% cap rates in Seattle and at 9% cap rates in Cleveland, because don't forget that mathematically the cap rate is a function of risk reward, right, and growth. Yeah. So you have to make sure that you're pricing the assets properly. So I'd say overall those are a lot of the markets that I'm looking at personally right now. I had been looking a lot at Denver and Nashville in the last I'd say 5 to 10 years, but not so much now because I think they've become very saturated. But definitely everything that's between Tampa and Jacksonville, very interesting. Phoenix also. I'd say Texas, but I am a bit worried that so many people are in Texas. Like it seems like every single guru and syndicator are all talking about Texas and with reason. But, to come back to one of my idols, Howard Marks, who is probably, arguably one of the best market readers, economically, and one of the best investors ever, I'm always worried when I see everyone going somewhere.
Yeah, sure. And I understand that. So I absolutely agree. And now
that doesn't mean I won't go there.
Yeah.
I'll go there, protected.
Yeah, sure. And what are some of the stress tests you like to put on your property? I'll take this another point. What are some, for someone who's just starting out, maybe they've syndicated a deal or they're looking into points, where are some of the side steps that you see a lot of people take that they need to avoid to be successful?
Well, people are making mistakes on the inputs that they're putting in. So depending on what the exit strategy is, because obviously like our internal rate of return is dependent on an exit, right? There has to be an exit in order to be able to compute an IRR. Now, an exit can be either a disposition, so selling the property, or it can be a refinancing of the property. And what I see people making too many mistakes is obviously the key metrics. If it's a refinancing, well, what is your refinancing interest rate? That's really important. People are just putting in these bogus interest rates. They're like, well, I'm financing today at 4.5. So you know what? 5 years from now, just to be safe, I'm going to plug in a 5.5 or a 6% interest rate. Okay. Based off of what? Well, I'm being conservative. No, you're not. That's not conservative. That's not based on anything. Conservatism is based on data and choosing the most conservative scenario. Now you're not basing anything on data. Therefore, it's not a scenario. It's just wind, right? So that's the one thing. And then obviously exit cap rate, right? So if your plan is to sell the property, well, what's your exit cap rate? Well, I purchased at a 5, so I'm going to put a 6 exit cap rate. Okay. What if it's a 7 though, right? Or what if it's a 5.5 exit cap rate? Because there's a double edge to that sword where you might make the mistake of over thinking how much return and performance you get, but you might also make the mistake of underestimating the actual intrinsic value of the property, which means you won't invest and you won't buy anything, and ultimately you won't have any return. So there's two things there, two sides to that story that you have to be careful of. So I'd say, people have to be really, really thoughtful of these inputs. Also be very thoughtful of what's rent growth going to be and what's the inflation of expenses going to be, because those are the other levers that will affect future cash flows and thus internal rate of return and net present value. So you really have to keep an eye on that and be very, very, try and be as precise as possible and as thoughtful as possible, and back your assumptions by data and readjust and re-question continuously what those assumptions are.
So let's pick one of those data points, let's say exit cap, right?
Yeah.
What would be some recommendations for people to be more precise with picking an exit cap if they're looking for a 5-year hold, 7-year hold, something of that capacity?
Well, obviously, the further out you go, the harder it is, right?
Yeah.
So I think you need to make many scenarios. So to come back to the question prior to this one, which I think they tie in together very well, is, kind of what's the risk management situation is, when you're underwriting, you shouldn't be just underwriting one scenario. You should be underwriting a whole set of scenarios, and then attaching your confidence level and probabilities towards each of those scenarios. And that way you can kind of see, okay, well, if I look historically, let's say at Atlanta, I look at historic cap rates, I can kind of find a range, right? And if I look at how interest rates have acted, and I'm listening to what economists are saying about future interest rates and all this, I can start to build these different scenarios. And as you build those scenarios, and obviously if you're someone who's done statistics or you're quant, you have access to, to stochastic modeling, to Monte Carlo simulations, I think that's even better. But ultimately, the simplistic way is simply to do a whole bunch of scenarios with different cap rates, exit cap rates, different growth rates, different interest rates, and look at what would be the consequences of those different scenarios. Which of those scenarios can you stomach? Which are more probable? Which are more improbable? And to which point can you stomach them? And what would be your plan B, plan C, plan D according to each scenario, right? So it might mean that on your first deals or on your next deals, you might just use less leverage, right? People get lazy. Syndicators get lazy. They're going to say, well, I'm purchasing a $10 million property. I've got 75% LTV financing. So I'm going to raise 2.5 million, right? Why not raise 3.5? Why not raise 4 million? Why not go for a lower LTV? Or why not underwrite for a rainy day? You might have to promise a bit less returns, but I always say under promise and over deliver, rather than over promise and under deliver, because you should be playing a marathon. This is a marathon,
Yeah, well, you're absolutely right. And those are just key solid points, is that you running your stress test, knowing your environment, it gives you a better way to I guess the easiest way is it gives you a better way to have ultimate ideas of how you're going to get out, because you're living in a property where you got 100, 200, 300, 400 people going on in there. The property is going to go sideways at some point, and not necessarily in a horrible way, but there's going to be something that's not going to meet your data. But if you run different tests to understand ultimately different things that could happen, it puts you in a better just case scenario. And just saying that every syndication I do 80% LTV or whatever it is, because that's what I do. So I guess that's following suit right there. What we're going after.
And you might even go for your full LTV, but maybe you'll keep cash reserves higher than were necessary, right?
Got it. Yeah.
Which will ultimately affect your overall returns that you'll offer to your investors, but really you're not, because people forget that returns are based on risk. So I see people saying, well, I've generated 20% IRR to my investors as a syndicator. I'm beating all these other syndicators who are doing 15. Yeah, but what's the amount of risk that you're taking, right? And are your limited partners, your passive investors, aware of that risk? What's the beta? People think that they're generating alpha, but they're not really generating alpha. They're actually probably even generating a negative alpha, because they're taking on so much extra risk just to generate that extra percent of return.
Love it. That's great. And yeah, you got to really appreciate your time. A few more questions for you. Just in terms of your business today, what is something that you do as a daily routine or other that helps you be so productive during the day?
It's funny because everyone thinks until you've started a business, if you're thinking about jumping into entrepreneurship or starting your business, everyone thinks that starting a business is the hardest thing, right? Getting off the ground. But it's not. And I've started 5 businesses already in 13 years. The hardest thing is managing growth, and that's the same for business. Whether you have a construction business, or whether you're a syndicator, or whether your business is not even in real estate. So I think the routines that I put into place is number one, making sure I set time aside for myself. And this is something that I was guilty of not doing for quite a long time, of sacrificing my health and my body and my well-being for just because I have so much to do. And I've experienced it myself, even though theoretically we all know this, but it's kind of one of those things where until you've lived both sides of it, you don't really know it, even though you do know it. It's like, eat your vegetables, if you want to be healthy. Everyone knows that, but a lot of people don't do that until they actually really get sick, right? So, I try and get up every morning at about 5 o'clock in the morning, just because I have 3 young kids. So they're up at around 6:30, 7 o'clock. So I try and get up early to do some exercise, to listen to some things that'll get my mind right, because no matter how strong you are mentally, sometimes you just need to hear, sometimes you need to listen to David Goggins on a podcast, or you need to listen to Jocko Willink or whatever, whoever it is, because it helps. And you're like, okay, you know what? I'm being a pussy right now. I need to, I need to get back to who I am. So just putting a bit of that time aside, and also putting time aside to think. It comes back to the story of the Pharaoh's children, his 2 sons, where the Pharaoh in Egypt has 2 sons, and he'll give one of them the empire. He'll give the empire to the son who is able to build a pyramid faster than the other one. Now, one of the sons is really muscular. He's like 6'4", and maybe I'm inventing this, but this is my version of the story.
Interpretation, sure, go for it.
He's 6'4", he's 230 pounds with like 5% body fat. He's like the Rock. So he starts by building the first floor or story of the pyramid with these big huge boulders and rocks and bricks. And after like a year, he's got like the first 2 or 3 stories built, right? And the other son, he's like really skinny, kind of a brainiac nerd, Revenge of the Nerds type. And after a year, he still has not started building his pyramid, right? Because he's building tools. He's actually building like a crane, kind of like a lever system. So the big son, the muscular one's like, yeah, I'm going to be the Pharaoh. I'm going to have the empire. Everyone's laughing at the other son. But at about year 2 or 3, the strong son, he's not able to lift up the stuff up to like the 3rd or 4th story. And there's like 10, 12 stories to go, right? And he's just destroyed physically because he's done all this heavy lifting and all this heavy work, and he's completely physically destroyed. Whereas the other son, well, he built a crane, or whatever the medieval or the, not medieval, but like ancient times in Egypt style crane, whatever you want to call it. He's built this lever system to lift these huge ass rocks and bricks. And by year 4, he's already like at story 8. And by year 5 or 6 or 7 or whatever it is, whatever the story says, I can't remember the timeline, he's built a pyramid, right? And he's not even tired because he's used tools and he's taken a step back to think and to strategize. Yeah. And that is the key to succeeding as a real estate investor or as a real estate entrepreneur, what I call a realpreneur, or even just as a normal entrepreneur, is making sure you take some time, whether it be 10 minutes or an hour, whatever time you need, to sit back, get a bird's eye view, act like a general, and think about what's going on and think things through. Because that's when you can start to build tools and also build an organization that will help you achieve your goals.
I love that. And it just goes down to a lot of you just, especially when you have your own business, sometimes you're just stuck so in the business that you forget to actually look at the business. And so that story actually just puts it all right out there that you just,
and don't get me wrong, you have to work in the business. Like it's kind of ridiculous. I hear so many people talking about, being financially free and not working and, only working on the business and not in the business. And, one thing, I'm not like a Gary Vaynerchuk fanboy or anything like that, but one thing I really liked was his metaphor of the clouds and the dirt. And the reality is if you eventually want to soar above the clouds, you have to start in the dirt and you have to work in both of those. And, you have to work in your business at first. I mean, unless you're a hedge fund baby or a trust fund baby, I mean, and you inherited a whole bunch of capital to be able to right away work only on your business, you're going to have to work in your business too.
Well, this has been awesome. I've really enjoyed this. Got two more questions for you. If there's someone listening today that's just been sitting on the sidelines and just looking for a way to get started, what's an actual step they should take today to get themselves started on their real estate journey?
Getting educated, obviously. I think a lot of people are just not educated enough, and that's what's preventing them from going into the market. And I think a lot of people are trying to go in it alone. And that's a mistake. I think we've lost our culture in the U.S. and I'm also Canadian and Canada. We've lost our culture of mentorship, but especially of apprenticeship. Back in the day, everyone started off as an apprentice. If you wanted to be a blacksmith, or if you wanted to be a butcher, or if you wanted to be a farmer or construction worker, you always started as an apprentice. You learned and you started as an apprentice. And I think that's one of the things we're missing in our society today is everyone wants to get rich quick. Everyone wants to have success fast. And everyone wants to be the CEO of their own one-person company. And I think a lot of people should, go and be apprentices and find someone like me or find someone like you or find, someone who's already doing it and who's doing it properly and maybe, be an understudy and invest behind them or work behind them and be a bit more patient. One of the biggest, probably the biggest mistake, the two biggest mistakes I've made in business, now and in hindsight after 13 years and being very, very successful, I can say this is three mistakes. Number one, I wanted to grow too fast. Number two, I partnered with the wrong people. I was too trusting and didn't do enough due diligence on the people I was partnering with, on the business partners. But ultimately, I wanted to be the number one guy too soon and too young and too fast. And if I could go back at the age of 22, I'd find someone who has the business that I want or has the success that I want. And I'd go and be an understudy of that person and work under that person and put my ego aside for a while and jump in the game that way.
Yeah, really well said. Thank you for that. And for everyone listening today, how can they find more about you? How can they find more about MREX? What's the best way to connect?
Well, the best way to connect with MREX is on the website, so www.mrex.co. Also, MREX has a Facebook page and a LinkedIn page. We post a lot of stuff. We're launching the Multifamily Real Estate Week, which is actually a 4-day event, which is going to be awesome. We'll be in Florida at the end of this year in the fall. And we're entering also with the College of the MREX, the College and Research Institute. So we'll be launching the certificate in multifamily real estate financial engineering. And you can find me and connect with me on LinkedIn and Facebook and Instagram. I'm extremely present, and it'll be my pleasure to talk shop with anyone who is already in multifamily or who's looking to get into multifamily. It's my pleasure.
Nikolai, I appreciate it. And for everyone listening, you've got a ton of value out of this today, but definitely check out his social media. It puts out great stuff out there, great thought points. So really appreciate you coming on the show. Thanks so much.
I appreciate the invitation, and thanks a lot for having me today.
Awesome. Well, everyone listening, thank you so much. We really appreciate you as a listener. And please go to iTunes, give us a 5-star rating and review. It helps other people find this great show. Again, thank you so much, Nikolai Ray. Thank you to all the listeners. Have a great day.
Thanks for tuning into the REI Foundation podcast. Check back next time for more awesome tips and strategies to launch your new you in real estate.